AFC Bournemouth just finished 6th in the Premier League. A club record, the first ever European qualification. Adoni Ariola walked away a legend on the South Coast. Everything about this season should feel like the beginning of something huge for the club. But here's the problem. The Premier League picked this exact moment to rip its financial rulebook. And the new rules might punish Bournemouth for the very success that they got them there. Welcome to the Premier League Finance Explained, Episode 1, AFC Bournemouth. This is a brand new series on the channel where we are going through every single Premier League club, one at a time, breaking down exactly where they stand under the new financial rules, what's changed and what it means, and what could actually happen to your club if they get it wrong. No jargon left unexplained. If you are new here, we build everything start first before we ever give our opinions. So by the end of this video, you would understand this rule better than most pundits talking about it on TV. We are using the same framework, football finance expert Kieran Maguire. We are using the same framework, football finance expert Kieran Maguire, the guy behind the Price of Football podcast, uses on his app, Valuball. Wages plus transfer amortization plus employer contributions measured against revenue. I will explain exactly what all that means in a few minutes and why that specific combination matters. First though, you will need to understand exactly what changed, because this is the biggest shift in Premier League financial regulation in over a decade. So let's start with what happened to PSR. For over a decade, Premier League football clubs were governed by PSR, which is basically meaning and sustainability rules. The mechanic was simple. Look at the club's losses, rolling over a 3-year window, and cap it at £105 million. Go over that, you risk points deductions. That's the rule that hit Everton and Nottingham Forest a few seasons back. But PSR had two massive problems. One, it only got checked retrospectively, sometimes years after the actual overspending happened, which is exactly how Everton and Forest ended up docked points mid-seasons for financial decisions made long before. Two, it had loopholes. Clubs could sell assets, hotels, women's teams, whatever to companies owned by the same ownership group, book it as revenue and say we are compliant on paper. Chelsea's sale of 2 hotels and their women's team to sister companies is the textbook example everyone points to about that situation. So, the 21st of November 2025, Premier League clubs voted. 3 proposals were on the table. 1, squad cost ratio, or 2, sustainability and systemic resilience, SSR. 3, a top to bottom anchoring. A proposal that would have tied every club's spending to a multiple of what the bottom club earns in central payments. Effectively, a soft salary cap. The anchoring got rejected. So now it was SCR and SSR passed by the tightest possible margin. 14 of 20 clubs. That's the exact minimum required. This was not an easy yes. From this season, 2026-2027, PSR is gone. SCR and SSR down. How every club in the league is going to get judged. And that's the loophole on relative party revenue closed. Only genuine football revenue counts right now. So how does SCR actually work? Okay, now this is where things are going to get a little bit tricky, but I'm going to try my best to make it as understandable as possible. Let's get into the actual mechanics, because this is where everything most explainers people. And this is exactly the part you need to understand for the rest of the series. Squad cost under SCR means player wages, head coach wages, agent fees, and the amortization of transfer fees. Quick definition on that last one. Because we use it constantly, we will use it constantly. Quick definition on that last one, because we will be using it constantly on this series. Amortization means spreading a transfer fee across the length of a player's contract rather than counting it all in 1 year. Sign a player for 40 million for 4-year deal, and that's 10 million a year hitting the books every year, whether the player plays every week or spends a season injured. Every Premier League club can spend up to 85% of their club's revenue, plus their net profit or loss from player sales on the squad cost. That basically is 85% line is called a green threshold. Let me basically repeat that so people in the back can understand. Every Premier League club can spend 85% of their football club's revenue, plus their net profit or plus from player sales on the squad cost. That 85 line is called the green threshold. So keep that in mind. The green threshold is something that we are going to be talking about again. So here's the part that trips people up. Crossing the 85% doesn't get you punished immediately. Clubs get a multi-year allowance of up to 30%, 30 percentage points, if I'm mistaken, on top of that. Meaning that they can go all the way to 115% of revenue before it becomes a sporting issue. That upper line is the red threshold. So if you get to 115%, line right there is now the red threshold. So between 85 to 115%, you get a financial levy. Not points, just a fine. And it's not a flat line. That's one key thing that we need to understand. It scales. The Premier League's own example is overspend by £250,000 and your ratio comes to around 89%. The fine is you overspend multiple by how far you are over 85%. So that is 250,000 times 0.04, I believe, 0.04. That would basically become a £10,000 fine. Let me just repeat that. So for people that, because I'm not a maths guy, you understand? 250,000 times 0.04 would give you a £10,000 fine. So that was what the Premier League has given as an example. So if you go above 115%, the red threshold, now it's a sporting issue. A fixed 6-point deduction. It's automatic. A plus, and then you get plus 1 additional point every £6.5 million spent above that line. That's real. It's immediate and a new season punishment, not a penalty handed 2 years later. Let me repeat that so people can understand. If you go above 115%, the red threshold, and it's sporting, it has basically gone the sporting route at that point. You are going to be getting a fixed 6-point deduction plus 1 additional point for every £6.5 million spent above that line. So that means if you go above the 115%, you get a 6-point deduction ASAP. If you then go higher than, if you spend 6.5 million plus, you're going over the 115%, you would then get an additional point every £6.5 that you spend above the red threshold. And there's the mechanism that actually matters, for the most long term anyway, because the negative feedback loop is what I'm worried about. If you breach the green threshold this season, your allowance shrinks by the same percentage next season. A promoted club records a year 1. Okay, technically fine. They are under the red, but they are red threshold next season. Their red threshold next season drops to stay compliant, and you rebuild that headroom back by 10% a season. It's a self-correcting system. Miss badly once, and you are operating under a tighter ceiling for years. One more thing, and this is the single most important detail for today's video specifically. Clubs playing in Europe do not get the 85% Premier League threshold at all. UEFA runs its own version of that exact rule, and UEFA's green threshold is just 70%, not 85, 70. The Premier League has no power to override that. If the UEFA says 70%, you are in Europe, it is 70%. Full stop. Keep that number in your head. 70%, we are going to get back to it. So quick word, how we are building these numbers for this series, because we want you to be able to check on our work and not just take our word for it. Kieran Maguire is probably the most recognizable name in football finance media in this country. Price of Football podcast is definitely a big one that we all listen to. University of Liverpool, football finance lecturer. The guy journalists call when the club accounts drop. He and Jason Laws built an app called Valuball. 30 plus years of English football accounts pulled directly from companies' house findings or filings, something any fan can actually explore. But here's an honest bit of transparency. Valuball's dedicated squad cost calculator sits behind their paid boardroom tier. So we are not pulling a pre-built number straight off the app for you today. We are doing what we are doing instead. And this is genuinely more useful skill for you as a fan, is building the same calculations ourselves, of course, from the club's own audit accounts, which is exactly where Valuball's own numbers come from in the first place. The formula is basically wages transfer plus transfer amortization plus employers' contributions measured against the revenue. Quick note on why the employer contribution specifically. Instead of the official rulebook's agent fees. Agent fees genuinely aren't always broken out cleanly in the club's public accounts. Employer national insurance and pension contributions, on the other hand, are required disclosures in the UK's company statutory accounts, sitting right alongside wages and salaries in the staff cost note. So this version of the formula is the best public proxy available, close enough to the real thing, to show you exactly where the club stands, using numbers anyone can go and check for themselves, as of course at the company house. So now let's put it into work on Bournemouth. Bournemouth's most recent published accounts cover the year to the 30th of June 2025, I believe. So this is the financial year that ended with the FA Cup quarter-final run and a 9th place finish before the historic 6th place finish that followed. Revenue was around £181.7 million, up from the £160.8 million the year before. But look at where the revenue actually comes from. £148 million of it, 81.5% of the entire club's income is Premier League Central distribution alone. Match day income is basically flat at 6.7 million. The Vitality Stadium holds around 11,300 people, the smallest capacity in the entire league. This is a club whose financial existence is tied to staying in the Premier League. There is no cushion if that ever changes. Now, the number that should stop you in your tracks. Total staff costs were £158.4 million. Against that is £181.7 million in revenue. That's a wage to revenue ratio of 87.2%, up from 84.7% the year before. And that's wages alone. before you added a single pound of transfer amortization on top. For context, UEFA's recommendation ceiling for a full squad cost formula, wages and amortization, and fees combined is 70%. Bournemouth's wage bill by itself is already 87%. That's a problem for Bournemouth. On top of that, player amortization for the year came in at £69.1 million, up from £61.6 million, driven by the £104 million of new player signings added to the books that year. Add wages and amortization together, and you are looking at roughly £227.5 million of squad cost against £181.7 million of revenue. On its own, that's over 125% of revenue. Miles past even the generous Premier League red threshold. Here is where Bournemouth's business model comes genuinely relevant for the survival under this rule. The squad cost ratio doesn't just measure against pure revenue. It measures against revenue plus net profit on player sales. And Bournemouth's trading profit that year was £91 million for Dean Hawson to Real Madrid, Milos Kerkez to Liverpool, Ilya Zubarny to Paris Saint-Germain, Dango Ouattara to Brentford. Those sales alone generated a further £39.6 million of grain booked just after this set of accounts closed. So run the full calculation, the way the SCR actually measures it. Squad cost against revenue plus trending profit, and Bournemouth land at roughly 83%. Let me give you that solution, or that, what would you call it, the equation again. For SCR, the way they calculate it, they measure it at squad cost against revenue, the trading profit. And Bournemouth land at roughly 83%, under the Premier League's 85 green threshold. Barely. I want to be straight with you on precision here. That 83% is our estimate, built from public accounts, not the official confirmed figure. The true number would use only first team and head coach wages rather than the whole club's payroll of over 900 staff, which would pull it down a little, but it would also add agent fees on top, which pulls it back up. Nobody outside the club and the Premier League has the exact figure, but the direction of travel is unmistakable. And it tells you almost everything you need to know about how Bournemouth and the club survives financially. Bournemouth's entire model is buy young, develop fast, and sell for huge, multiple, and repeat. That is basically their model. Take the player trading profit away, and the club is nowhere near compliant with anything. Now we look at their situation with the Europa League. Now here is the twist that Bournemouth, genuinely the most interesting case study to start this series with. Remember the number I told you to keep in mind, 70%. Bournemouth didn't just have a good season. They had the best season in club's history. 6th place, 57 points, a club record, Europa League qualification for the first time ever. Adonia Areola's parting gift on his way out of the door after 3 years on the South Coast. But by qualifying for Europe means Bournemouth are no longer judged against the Premier League's relatively generous 85 green threshold. They are judged against UEFA's 70%. Our estimate have them roughly at 83% against the domestic rule. Against UEFA's numbers, that's barely under it anymore. That's a real, meaningful breach territory. And that isn't theoretical. UEFA is actively enforcing this right now. Just last month, July of 2026, Aston Villa were fined £19.4 million for breaching the 70% threshold. Chelsea, 2.6. Nottingham Forest, 2.2 million. Newcastle, 2.6 million. This is a live enforced rule with real financial consequences landing on the Premier League clubs as we speak. Crystal Palace are living almost the exact same story as Bournemouth right now, a club that qualified for Europe on merit and immediately found their spending power more restricted, not less. Because of it, success became their trap. That's the central irony of this entire video. The best season in AFC Bournemouth history may be the single event that puts them on most pressure on their finances under the new rules. Yes, I know it's absolutely annoying to think about, but that's the rules, and those are the rules that the Premier League absolutely voted in. Adone Areola left this summer after 3 seasons that took Bournemouth from mid-table survival to a European finish. Former RB Leipzig, Bournemouth manager, and Borussia Mönchengladbach boss Marco Reus is his replacement on a 3-year deal. Walking straight into a European campaign, a brand new head coach relationship to build, and a financial ceiling that's lower than it's ever been before for the club. And this summer transfer window hasn't exactly eased the pressure, to be honest. It hasn't. As of recording, Bournemouth have spent roughly £54 million on Alvaro Rodriguez from Lecce, or Elche, I think that's how you pronounce it. Antonio Silva from Benfica. Juanlu Sanchez from Sevilla. Against almost nothing recouped in sales so far. Every pound of that adds fresh amortization onto next season's books. At the exact moment, their threshold got stricter. The one thing working heavily in their favor is the ownership. Bill Foley's Black Knight Football Club has already converted £157.6 million of shareholder debt into equity, injecting fresh cash. They refinanced onto the Goldman Sachs facility. This is not a club at risk of running out of money. This risk here isn't insolvency. It's football's sanctions. If the spending to revenue math doesn't work out, regardless of how deep the ownership's pockets are. So what is it that you need to watch? So what do you actually watch for Bournemouth this season? 2 things. 1, further sales before the window shuts on the 1st of September. More outgoing transfer profit is the single biggest lever that they have to boost their revenue plus trading profits side of the equation. 2, how Central Premier League and the UEFA contributions from the new broadcast cycle land in this year revenue line. Basically, they're waiting to see how the Premier League and the UEFA that are basically going to give them money in the broadcast deal helps them out. Because a bigger denominator makes a whole problem easier to manage. This is a club that got here by being smarter than almost anyone in the market. Under SCR, being smart isn't an option anymore. It is the entire business model. That's the episode 1. Next up in the series, we are heading to Arsenal. So drop the comment telling us which club you want us to break down next. And subscribe so you do not miss out on it. If this actually helps you understand the new rule or make sense of the new rule, hit the like button. Genuinely helps us reach more fans who are just confused about all these new rules and all these new football things changing. So do us a favor, hit the like button. If you can hype it. If you can comment down below where you need me to explain a little bit more, I will. But make sure you guys hit the subscribe button. You do not miss out on us talking about the champions, Arsenal, because we are going to be going from alphabetical order AFC Bournemouth, and now we are going to Arsenal Football Club in the next episode, in episode 2. I'll see you guys in the next one. Much love. Peace.